Welcome back to the channel, everyone. If you're serious about growing your wealth, especially over the long term, today's video is one you absolutely need to watch from beginning to end. Because today we're diving deep into one of the most important, but most overlooked, investing habits: rebalancing your investment portfolio. If you've ever asked yourself, when should I rebalance? How do I rebalance without messing things up? Do I rebalance monthly, quarterly, yearly? Does rebalancing really make a difference? Then you're in the right place. By the end of this video, you'll know exactly how to rebalance your portfolio like a professional, how often to do it, and how to avoid the most common mistakes. Let's get started. Section 1. What is rebalancing? Let's begin with the basics. When you invest, you don't just put all your money into one thing. At least, you shouldn't. You build a portfolio. That portfolio is made up of different asset classes, like stocks, bonds, real estate, cash, and sometimes alternatives like gold or crypto. When you start, you might set a target allocation. For example, 60% stocks, 40% bonds. Pretty simple. But here's the problem. The market does whatever it wants. If stocks go up 20% and bonds barely move, your 60/40ths portfolio might turn into something like 70/30ths. Now you have more risk than you originally signed up for. Rebalancing is the process of bringing your investments back to your original target mix. It's like course-correcting a plane. You don't wait until you're 200 miles off track. You adjust along the way so you stay on your intended path. Section 2. Why rebalancing matters. A lot of people think rebalancing is optional. It's not. Here's why it matters so much. 1. It controls your risk. If your stock allocation keeps rising, your risk rises too. Rebalancing brings your risk back to a level you're actually comfortable with. 2. It forces you to buy low, sell high. This is the big one. When you rebalance, you sell assets that have gone up high and buy assets that have gone down or lag low. You're doing automatically what most investors struggle emotionally to do. 3. It improves long-term returns. Rebalancing helps smooth out volatility and improves risk-adjusted returns. You get more predictable growth with fewer surprises. 4. It prevents emotional decision-making. Instead of reacting to scary headlines, you follow a systematic rule. When my allocation drifts too far, I rebalance. It keeps emotions out of your investing. Section 3. Portfolio drift explained. Let's visualize portfolio drift because it's one of the biggest reasons rebalancing exists. Imagine you start with $10,000 total, $6,000 in stocks, $4,000 in bonds. Now imagine stocks go up 15% and bonds go up 3%. Your portfolio becomes stocks, $6,900, bonds, $4,120, total, $11,020. Now your allocation is 62.6% stocks, 37.4% bonds. Not a huge shift, but over years, this drift can get dramatic. If stock markets boom for several years, you might end up 80% in stocks without realizing it. That's a problem, because your portfolio no longer matches your risk level. Rebalancing fixes this. Section 4. When should you rebalance? Now we get into one of the most misunderstood parts of rebalancing. How often should you do it? There are 3 main strategies. 1. Calendar-based rebalancing. This is the simplest. You rebalance on a regular schedule. Once a year, twice a year, every quarter, some even monthly, but that's usually unnecessary. The most common and recommended. Once a year. Benefits: simple, easy to automate. Low emotional stress. Downside: you may go long periods with too much drift. 2. Threshold-based rebalancing, also called drift rebalancing. You rebalance only when your allocation drifts a certain amount. Example: if stocks are meant to be 60%, you rebalance if they drift to 65% or drift down to 55%. Most common thresholds: 5% rule, 10% rule. This method is more precise and aligns closely with risk control. 3. Hybrid method, best of both worlds. You combine both, annual checkup, and rebalance anytime you drift past your threshold. This is how a lot of financial advisors manage portfolios. Section 5. How to rebalance step by step. Okay, Now let's get practical. Here's how you rebalance your portfolio step by step. Step 1. Identify your target allocation. This could be 80% stocks, 20% bonds aggressive, 60% stocks, 40% bonds balanced, 40% stocks, 60% bonds conservative, or something more detailed like 50% US stocks, 20% international stocks, 20% bonds, 10% cash. Step 2. Check your current allocation. You can do this using your brokerage dashboard, a spreadsheet, portfolio tracking apps, target versus current. Step 3. Calculate the difference. How far off am I from my target? If you're within your threshold, you may not need to rebalance. Step 4. Use new contributions to fix drift best method. This is the easiest and most tax efficient. Let's say your stocks are overweight. Instead of selling stocks, you simply direct your next few contributions into the underweight assets like bonds. This avoids taxes and trading fees. Step 5. Rebalance by selling and buying if needed. If contributions aren't enough, you rebalance manually. Sell assets that are overweight, buy assets that are underweight. This brings everything back in line. Step 6. Document your rebalancing decision. A simple note, date, reason for rebalancing, allocation after rebalancing. This helps keep your strategy consistent. Section 6. Real example walkthrough. Let's run through a real example so this all clicks. Imagine a portfolio with the following target: 60% stocks, 30% bonds, 10% international. Today, your $20,000 portfolio looks like this. $14,000 stocks gives 70%. $4,000 bonds gives 20%. $2,000 international gives 10%. You're way overweight stocks. Your goal: stocks should be $12,000. Bonds should be $6,000. International stays at $1,000. To rebalance, you'd sell to $1,000 of stocks, buy to $1,000 of bonds. Boom, you're back to target. This is how professionals do it. Section 7. Rebalancing in retirement versus early investing. Rebalancing changes depending on where you are in your investing journey. If you're young early investing years, you can rebalance less often. You usually want more risk. Market volatility is your friend. Most young investors rebalancing once a year is perfectly fine. If you're closer to retirement, rebalancing becomes critical. You want to reduce risk over time. Move from stocks gives more bonds. Keep volatility lower. Protect your capital. Many retirees rebalance twice a year or use a threshold model to maintain stability. Section 8. Taxes and rebalancing. This is where rebalancing gets tricky. Taxes. If you're rebalancing in a taxable account, selling assets that have gained value equals capital gains tax. So what do? Here are smart ways to rebalance while minimizing taxes. 1. Rebalance inside tax-advantaged accounts. These accounts often let you sell without triggering immediate tax. 2. Use new contributions instead of selling. We mentioned this earlier. It's the most tax-friendly method. 3. Use dividends to rebalance. Direct dividends into your underweighted assets. 4. Tax loss harvesting. If you have losing positions, selling them can offset gains from rebalancing. Section 9. Common rebalancing mistakes. Before we wrap up, let's cover the mistakes investors make with rebalancing. Mistake 1. Rebalancing too often. Doing it weekly or monthly leads to excess trading, higher taxes, worse performance. Mistake 2. Not rebalancing at all. This is the biggest mistake. Your portfolio turns into something you never intended. Mistake 3. Changing your allocation too often. Rebalancing is not changing your strategy. Your target allocation should only change if your goals change. Mistake 4. Panic selling. Rebalancing is systematic, not emotional. If you're rebalancing during a downturn, you're buying low, not panicking. If you found this video helpful, make sure you like, subscribe, and turn on notifications so you don't miss our next deep dive. And comment below, how often do you rebalance your portfolio? I'd love to see your answers. Thanks for watching, and I'll see you in the next one.